Well, it's time now for Mike on the Money. We welcome Mike Giordano, financial advisor with Williams Wealth Management and a new daddy of beautiful Margot. We showed you the picture last week.
She was very appreciative to make her debut.
Oh, yeah.
She's like, wow, Jane knows
and
me?
she
I was
looked
like, that's right, Margot.
stunning. And your wife looked like not even 24 hours late, but we're so excited about your family. So today we want to talk about staying a step ahead, because you've got 3 little ones like Mike does. You know how to stay a step ahead. Paying back student loans, let's start there, Mike, because starting in September, people who had those loans deferred because of COVID are going to have to start paying it back. How do they make plans now to re-budget?
Yeah, well, and the best thing to do is start focusing on that now. Start thinking about how can I set aside the money that I'm going to need. If you say you need $200 for those payments, start figuring out how you're going to get that $200 right now. If you can skimp out on some expenses, then that's the perfect way to go. Maybe you can find a way to raise your income. That's another thing. So the best thing to do, though, is find a way to make up the money so you can make the normal payments. If for some reason you can't make normal payments, there are a whole bunch of income-based payment programs that are more pegged to your income. So the payments may be lower earlier and then they go higher later, but you may end up paying more interest over time. So it's a great fallback option, but the best thing to do is be able to make normal payments.
Great, and just get it done.
Absolutely. I mean, it's very much like if you have a car, you paid off your car. For a little period of time, you didn't have any payments, but then all of a sudden you want a new car. You got to start budgeting for that stuff. That's
great advice too, to staying ahead of the car thing. What about inflation? We're taking a look at everything happening with inflation. Everything costs more, including what I'm paying on credit card. Do I pay off my credit card, or do I save money, or is there a way to do both?
There's a way to do both, for sure. The best thing to do is that when you think about paying off credit cards, anything that's double-digit interest or high single-digit interest, those are the things you want to pay off as quickly as possible. If you don't have any of that kind of debt, then you can start looking at putting more money into savings. And when you're taking a look at trying to counter inflation, over the long term, the best way to counter inflation are growth assets like stocks, real estate, that way. To a lesser extent, long-term bonds. But in the short term, if you can't handle any price volatility because you need the money over the next year or two, then you want to look at those high-yield savings accounts or money market funds in a brokerage account, because they're paying upper 4s, 5% interest, which is better right now than the 3% inflation rate.
Yeah, and that's great to note too. Not all savings accounts are created equal, so really
for sure they aren't. So make sure you're looking at what you're getting paid.
Okay, some people want to buy a house. Mortgage rates are the highest they've been in a really long time. How do you even begin? Look at this 30-year fixed rate, 7.37. Do we go for it, or do you hold out and wait to buy the house?
Well, it depends. You want to keep your fixed costs under 50% of what you're making, right? And really debts you want to be under about 1/3 of what you're making. So that's the first thing. So that's how you maintain financial responsibility. In terms of the interest rates and all that stuff, the best thing to do is if you can somehow, save a little bit more money and get a bigger down payment, then there's less money for you to have to borrow. It depends on what kind of house you're looking to buy too. If you're looking to buy a new home, new construction, there's a lot of builders that have programs that will buy down some of that financing cost on the front end for the first few years, and then hopefully if rates fall back down, then you can refinance for the longer term. If it's an existing home, you don't really have that option.
Good. Again, you've got options.
Yes.
Take a look at it.
Yes.
And then, credit ratings. We always kind of look at what is your credit score? Something that can save you money at some point?
Well, Jane, I mean, it definitely can save you money. Think about if you were lending money to a friend. You got a reliable friend and an unreliable friend. Who are you going to loan the money to, right? And certainly, if you're willing to loan money to both because you're such a nice person, you're going to lend more money to the reliable friend than the unreliable friend. It's the same thing. That's what credit scores are. The higher your credit score is, the more reliable you are to pay back the money that you've borrowed. And so if you're more reliable, you're going to typically get a better interest rate, and you're going to be able to borrow more money.
And staying ahead of what you might want to borrow for the future.
Most important thing, there's so many factors, credit scores, but the most important thing is making those payments on time.
Excellent. Mike Giordano, it's always great to be with you. Hi to the family. We'll be right back.